inflation is high, we need to increase interest rates to slow the inflation. And as interest rates increase, the value of those bonds decrease. So just be aware of what you hold. The longer the term of the bond, the more volatility or more impact those interest rate increases will have on those bonds. But do continue to expect, increased volatility. I think 2022 can still be a positive growth year with some of the things happening within the market, the infrastructure bill. You might have certain sectors that are going to perform a little bit better than others in this next year. But just know what you own and invest with your risk tolerance. That's everything I have, Lynn. Go ahead and take it back over.
All righty, very good. I will get back to the share screen thing if I can figure that out here on my computer. Again, as I said, turning it over to the old fella here is a little bit iffy. All right, give me a thumbs up if you can see that screen, and then I'll go ahead and start our little show. We good? Okay, so I want to address today just a little, well, it helps if I can hit the right button. Some year-end lists, the top 10 year-end, some tax planning, some top 10 financial planning ideas, and then some extra credit. So that's kind of what our agenda is today. I'm going to give you a quick look at some top 10 year-end tax planning. Here they are. Number one, pay attention to your tax bracket. You want to look at some ideas about accelerating income perhaps this year, and maybe deferring deductions this year, because taxes are kind of at an all-time low right now. We do have a great sense that the taxes in the future are going to be going up significantly. This is the quick 10 overview. I'm going to consolidate this and the other 10 into 7 that we're going to address a little bit more in detail. Itemized deduction timing, accelerated or deferred deductions. Again, we don't give tax and legal advice. We're going to give you coaching ideas. We say trust but verify. Always consult a competent tax or legal advisor. Gain and loss harvesting. We'll probably touch on that a little bit on my summary. Roth conversions, we're going to touch on again. If you know our firm and our interactions that we have, we talk a lot about Roth planning and Roth conversions. Charitable planning. Review your estate plan. We're going to touch on that a little bit more. We are in a very low interest rate environment, as Brandon mentioned. Review that portfolio on a regular basis, and maximize tax advantaged vehicles, and review beneficiary designations, especially in relationship to the Secure Act and what that does to accelerate taxation on money that's inherited. So that's the game plan there. On the financial planning forefront, boost your retirement contributions at work as you're able. Use flexible spending account dollars and make HSA contributions. That's all I'm going to say about that. I mean, any of these topics or bullets that you want follow up on, feel free to write those down and then just follow up with us via email or a phone call and say, hey, I want to learn more about that topic. We'll make sure that we address that individually. I'm just kind of throwing a big wide net here, and then I'm going to focus it on just 7 specifics. Look at that marginal and capital gains tax issue. There's changes coming. Pay attention to the American Rescue Plan and how that impacts taxes and other things. Rebalancing the portfolio, we'll talk a little bit about that. Charitable giving, we'll talk about that. Form a plan for stock options. If you've got a business or some other type of a stock option opportunity, you need to be looking at those things. Prepare for your RMDs and that kind of thing, and then adjust if you have any student loans. You need to be looking at some repayment on student loans and some planning in that area, and then the overall estate plan. I'm hearing some weird noise in the background. I hope that's not
just muted somebody. Keep on going.
That's not my stomach. That's not, Okay. So anyway, here's our top 7. So from that big list, here's the top 7 that we're going to deal with today. Tax planning, charitable contributions, portfolio, estate, retirement plan contributions, RMDs, and Roth IRA conversions. And so let's get right into it. By the way, I forgot to mention, I was supposed to start this since we're in December. I got a little creative and said, I'm making a list, checking it twice, gonna find out who's paying attention or not. Okay, sorry about that. I mean, I had to do something for the Christmas holidays. He knows if you've been taxing. He knows your RMDs. He knows if you've made money or not. So report for goodness sake. Okay, I won't bore you with any more of that. I had to get that out. I mean, you know, I thought it was a real funny idea. I'm sure my staff here is just shaking their head going, there he goes again, chasing squirrels. All right, tax planning. Let's talk about that. What do we need to pay attention to in tax planning? Now, I've put a few bullet points here. Again, with the limited time we have, we're going to give you some good information, and then we encourage you to follow up with us and we can make it fit your situation. Look at your tax bracket. Accelerate income and defer deductions. That might be a good plan as it relates to tax planning, because we all sense that taxes are going up. So perhaps we ought to get more taxes paid now and not take deductions now relative to taxable investments. Itemized deduction. You might want to look at that. There's some significant changes to itemized deductions coming up. I'll address that a little bit later in the sense that, well, let me address that now. In 2021, most people are using that standard deduction. With the changes in tax law that are on the horizon, we may be wanting to look at itemized and not standard. So just pay attention to that. Again, talk to your CPA, your tax person. Gain and loss harvesting. Make the most of reduced capital gains taxes right now. Okay, forecasts are right now we have a capital gains tax rate of 0 or 15 or 20, depending on your income. Well, that's going to potentially double in the next year or two. So if there's assets that have significant capital gains that you're thinking of letting loose in the near future, now is the time to be considering that. So that's all I'm going to say about the tax planning issue. Just some quick bullet points, a little more detail to dig into it a little bit more, give you some ideas. All right, let me go to the next one. Charitable contributions. This is another change that occurs at the end of this year. Right now, you can contribute up to 100% of your AGI if you donate to a charity. So you could donate your entire income, adjusted gross income, to charity right now and forego any tax on that money. That reverts back to just 60% after this year. That may or may not be important to you, but that's just something that we want to point out. If you have some assets that are significantly appreciated, consider gifting those assets to charity to avoid a capital gain. If you're not needing those assets and you're thinking of gifting those, well, a charity would be a great place because there is no tax on that gift. You can give that to a charity and they can benefit greatly as well. There's a thing called a charitable IRA rollover. If you are age 70 and a half or older, you can make what's called a qualified charitable donation from your IRA to a charity. You can do up to $100,000 and gift it to a charity. That gift does not count as income, but it does satisfy your RMD. We get this question all the time from clients that are like, look, I have this nest egg that I've built up. I was a disciplined saver. I did what everybody told me to do, and I put all this money away for retirement. I don't need all that money right now. I'm blessed. I got pension. I got Social Security. I've got, other income coming in. I don't need that. I don't want to take it. Well, you have to take your RMD. You have to at once. Now, of course, the age has changed to age 72. But here's an idea. If you don't need the income from the retirement account, but you're being forced to take the RMD, required minimum distribution, donate it. And you benefit the charity. You end up not having to pay any taxes, and you satisfy your RMD on money you don't need, if that's your situation. So a nice idea there to consider in your planning. Number 3, portfolio rebalancing. Very important that you pay attention to your mix. Equities, fixed income, not just risk exposure, that's important, but also the mix of where you're at and the taxation exposure on those portfolios. So do you have some capital gains that you want to realize right now while capital gains are on sale? Pay attention to that. Okay, what's your risk profile? Do you have some tax losses that you could harvest? In other words, you could take some losses on assets this year that have occurred and pair those up against gains so that you reduce your overall capital gain as well. So we call that tax loss harvesting. So if you've had that discussion, with us or with your advisor, if you haven't had that discussion, make sure you have that in case there's some opportunity there for you. If you have assets that are taxable that have highly appreciated, we need to have a chat about reducing the tax exposure and a rebalancing strategy, because we may be heavy in that one area, and you don't want your portfolio out of balance. You want to balance things up, and maybe you can do some gifting or some harvesting and get things back into balance. All right, that's it on that topic. Estate planning. Have there been any changes over the last 12 months? Do you need to update your beneficiary designations? It's a good thing to kind of review that on an annual basis, because marriages may have occurred, or divorces, or perhaps somebody has passed away, as I call graduated, or there's been birth, or maybe there's an inheritance, or you won the lottery or whatever. Those are things you need to pay attention to in this year, and get your estate plan reviewed to make sure that things are set up properly for tax exposure, for inheritance, those kinds of things. If you have a business, have you been putting into place some kind of succession plan for that business? Statistics are pretty significant that without succession planning, many businesses last one generation. That's it, because the planning did not allow them to endure into the next generation. So get some planning done if you're in that boat. Right now, we have an estate tax exemption of $11.7 million per person. That's going to revert to the old levels at the end of 2025 or earlier. That may not impact many of you, but if they bring back the estate tax at $1 million or $2 million or $3 million or wherever it might come back at, that's something we need to pay attention to, because all your assets go into that calculation. Your house or houses, your insurance contracts, your investment contracts, all of that is going to be included in your taxable estate. Like I said, 11.7 million right now. For you're not bigger than that. Land, businesses, you name it. It all goes into that kitty. And if you go above that exemption, the tax can be 30 to 50% on that, plus your ordinary taxes. So that's a huge one. All right, inherited IRAs. This is another big change. Used to be that as we graduated and passed our IRA onto a non-spouse, that non-spouse could stretch that distribution out over their life expectancy, let it grow, and they had to take a little bit out, but they could let it grow and just go. They can't do that anymore. That now it has to be liquidated within 10 years of the date of the original owner's death. Now, there's some planning that also impacts spouses here. So if you are a beneficiary of an IRA as a spouse, there's some new rules there that we need to pay attention to. If you're concerned about that, give us a call. We'll make sure that we address those rules with you. And again, trust but verify with your appropriate tax professional. And then, of course, I've already said that the inherited IRAs, you got a 10-year window. There's various other techniques. You can use charitable remainder trusts and other things to still employ some stretch, what we call stretch IRA distributions. There's some control issues there that you have to be familiar and comfortable with before executing that. There are some techniques that you can stretch IRAs, but not as easy as we used to before this new rule that was put into law last year. Tax elimination wealth transfer. This is a simple concept where we teach folks how to minimize the taxes on your IRA retirement assets and create tax-free money for you to help pay for long-term care, terminal illness, tax-free money for your heirs if you graduate, and tax-free money to go to charity for assets that you don't use. When you've already taken care of your family and yourself, you can reposition assets to a charity tax-free. In the middle of all this, Uncle Sam ends up getting a whole lot less than what he was counting on. So we like teaching folks about tax avoidance. We do not sponsor tax evasion. That's illegal. But tax avoidance is a good thing. So be informed. All right. Here's the new laws or numbers on retirement plan contributions. I thought you might like to see that. Right now, if you participate in a 401k, your cap is $19,500. That will be increasing next year to $20,500. That's your contribution max for the year. If you're 50 years old or older, then you have an additional $6,000 a year catch-up available to you. IRAs and Roth IRAs stay the same as they were last year. No changes there. It's $6,000 is the max. And if you're over 50 years old, you have a $1,000 catch-up that you can do there. Don't forget, we see this frequently, that perhaps one spouse has already retired or is primarily working at home. You can fully fund that non-working spouse's IRA. You can fully fund that even though that spouse is not working, as long as you are working, one of you. And of course, you can put up to, if you're over 50 years old, you can put $7,000 in yours and you can put $7,000 in your spouse's. So take advantage of that. That's an idea that you might want to pay attention to. Social Security taxation. Social Security is taxed on wages up to a certain amount. And if you're over that limit, then they're not withholding Social Security taxes from your payroll anymore. That limit was $142,800. That's going up to $147,000 next year. All of your income is going to be taxed for Medicare, but only up to that level is taxed for Social Security, which may or may not be important to you, but I'm just sharing data, sharing information with you. Okay. Okay, let's talk a little bit more about RMDs. You must start taking money out of any kind of retirement account the year you reach age 72 and every year thereafter. I mentioned that a little earlier. Many times folks are like, I don't want to take that out. I don't want to pay taxes on it. I don't need all that money. I'm sorry, I don't make the rules, but I want to make sure that you follow the rules, because if you don't process that required minimum distribution and your tax return gets audited, you're looking at a 50% tax penalty. Ouch. On top of the regular taxes that you were supposed to have paid. So don't goof that up. RMDs are not the responsibility of your advisor. They are not the responsibility of your custodian, whoever's holding your money. They are your responsibility. So you need to pay attention to that on an annual basis at age 72 and every year thereafter. Now, most custodians and most advisors are proactive and coach you and communicate with you about that requirement. But you have to make sure that that happens. They are not going to just do that for you. You either have to set up an annual distribution form or do it every year manually on your own. Just pay attention to that. This is important for your folks too. Because sometimes with our folks, if they have some retirement accounts and they get into their 80s and 90s, they might get a bit forgetful. We don't want them to be subject to that kind of penalty. So help your loved ones, help your family, communicate this to everybody so that nobody has to pay those penalties. If you're, again, I mentioned this earlier, if you're 70 and a half or older, consider that a qualified charitable distribution as an alternative to being taxed on that RMD. If you don't need the money, then donate it. Donate up to $100,000 every year to a charity, and you don't have to pay taxes, and you've satisfied your RMD. So that's kind of a neat planning tool. Some people will use that for church tithes and other types of nice contributions that you were already making. Well, now let's get an additional tax relief from that as well. All right, Roth IRA conversions. We talk a lot about this in various presentations. Obviously, we all feel that there's a higher tax rate coming in the future. So it's a good discussion to start looking at converting now at lower rates. For you, and this benefits not just you, it benefits your spouse, it benefits your beneficiaries, because you're the one that has the tax burden, but when you graduate, that burden passes on to your spouse and or family or beneficiaries. So converting stuff to a tax-free position now is a good thing. And I'm not saying do it all at once, no, but get a structured plan and look at maybe over the next 3, 4, or 5 years or so. Start looking at some strategy there if you haven't already. Our tax bracket is a progressive tax bracket. 0 to whatever is taxed at 10, and then up to a certain point is taxed at 12, and then up to a certain point it's taxed at 22, and so forth. If you've got plenty of room in your 22 tax bracket to where maybe you can absorb another 50,000 of income without jumping from the 22 to the 24 or the 24 to the 34 or wherever you're at, have that discussion. And that's how we do some of those Roth conversions. We don't want to force income into a new tax bracket, but use up your existing tax bracket and get some tax-free planning in place. By the way, in doing that, it reduces your future RMDs because there are no required minimum distributions on a Roth account. Again, as always, there's exceptions. If a Roth account is inherited, then your beneficiaries have a required minimum distribution. Go figure that out. Why in the world would the IRS force, I'm off on a tangent here, but why in the world would the IRS force required minimum on a tax-free asset? Well, that's just a weird rule that if your Roth goes to a beneficiary, they're forcing them to do a withdrawal out of that darn thing every year. So that's a weird thing. I didn't put that on my slide, but the thought triggered, so I'm sharing it with you. By the way, we get this question frequently. Does a Roth conversion satisfy my RMD? In other words, can I move from an IRA to a Roth? Can I transfer from an IRA to a Roth direct from one custodian to the other? Can I do that? Well, yes, you can. But does that satisfy your RMD? No. So don't do that. You've got to take that money to yourself to satisfy the RMD. It does not work custodian to custodian in that regard. So be very careful with that. Again, as always, tax-free or tax advice, legal advice, check with your professional resources. Okay, I think that's about it. I want to just end with a couple of quick questions because we're getting these a lot right now. We're getting questions like, I'm worried that inflation will stymie my equity portfolio's growth and may even send shares plummeting. My response to that is the sky is not falling. Inflation is not out of control. Yes, it's surfacing itself, but please don't knee jerk on that. Inflation has a huge history. I don't want people panicking. We can address this more directly individually if you're concerned about that. If that's a concern, make a note and we'll chat. Another question, how do I know which equities are most advantageous for me to own at this time? Well, we can chat about that. If that's a concern, I'm just throwing a few nuggets at you. If you're interested in that, great. Talk to us. We'll address those because we're short on the time here today. I hear the supply chain bottleneck will probably last for years. That is greatly exaggerated. We got issues, yes, we do, but please, you have to understand that everybody out there has an agenda, has a bias. I guess be informed, but verify. Don't just knee jerk. I'm afraid that with this pandemic resurgent and these new variants, that the market could go real bearish real quick. You know, that's an unknown. We had a market reaction in March of last year with the vaccination rates where they are and all of the medical technology where it is now. I don't see the need for us to be panicking about these new variants. Be concerned, yes, but to panic and go crazy with markets, investing and stuff, I don't think that's appropriate. So let's not knee jerk. Let's understand the reality and not get scared. And then with this high inflation, is that going to lead to a weak market the rest of this year? Well, inflation's there. It's not terribly high, but it's certainly growing. Look, I was in the 80s. I remember gas lines. I remember interest rates, inflation rates and CDs and everything else in the 16, 18, 14 range. I've been there, done that. Markets historically, November and December have had fairly strong performance. So I don't want you knee jerking out of the market just because of that inflation worry that's all over the news. So those are just some of my main points. I think that's about it for today. I don't have any other agenda here to discuss. You know, I'm not real sure if we're supposed to open this up. I forgot to say if there's some questions, we can certainly address some questions. I see there's a few things in the chat box. And I think in the interest, Lindsay, you help me understand this. What's our time frame today? Was it about 30 minutes?
Yeah, it's about 30 minutes.
And I think we're there.
We are there.
So I blabbered too much. I will address these chat questions offline, if that's okay. And but if anybody wants to cut in front and do a verbal question, I'll address one or two, and then we'll sign off and wish everyone a Merry Christmas and a Happy New Year and health and peace of mind and give out good comes back.